When interest rates drop, homeowners scramble to lower their monthly payments. The prospect of keeping extra cash every month creates a powerful urge to sign new mortgage documents as quickly as possible. However, a lower monthly payment has little value on its own. Securing a new rate requires thousands of dollars in upfront capital. Refinancing is a calculated investment. You pay thousands of dollars today with the expectation of recovering that cost in small monthly increments over several years. This matrix compares identical refinance offers saving $200 monthly, based on timeline. In column A, moving in 2 years saves $4,800. Subtracting $6,400 in closing costs leaves a $1,600 net loss. In column B, staying 10 years incurs the same fees, but accumulates a $17,600 profit. The math on the loan document only matters if your realistic life timeline exceeds the mathematical timeline of the loan's cost. Mortgages operate on rigid mathematical structures. Once the terms are set, your finances are locked into a static configuration. To find out if a new loan structure actually generates wealth, you have to find your break-even point. This is the definitive metric that proves whether a refinance offer is actually profitable. This flowchart illustrates the specific equation you need. You take your total closing costs and divide them by your projected monthly savings to find the exact number of months it takes to break even. Standard closing costs typically range from 2% to 5% of the new loan amount. On a $320,000 balance, you're looking at thousands of dollars in appraisal fees, origination charges, and title insurance. Dividing these heavy upfront costs by relatively small monthly savings creates a strict 2 to 5 year break-even window. Selling or moving before reaching this exact month means you are subsidizing the bank's administrative costs rather than saving your own money. Wealth retention only begins on the first month after this break-even date is passed. A refinance calculator's true purpose is to pinpoint this exact date so you can compare it against your life plans. If you don't have the liquid cash to pay these fees up front, lenders will offer alternative structures to fund the new loan. A no-closing cost refinance requires zero cash at the table, creating an immediate day-one break-even point. This convenience has a permanent trade-off. To cover the fees, the borrower must accept a higher baseline interest rate, which often costs thousands more over the long term. Alternatively, you can roll the upfront closing costs directly into the total balance of the new mortgage. Preserving your cash today means you will pay compound interest on those administrative fees for the next 30 years. Refinancing always requires a sacrifice. You either spend upfront cash, accept a higher interest rate, or inflate your total debt. Calculators are objective math engines. Garbage inputs will produce flawed financial projections. This data table breaks down a true monthly payment. Comparing only principal and interest is misleading. You must include property taxes, homeowners insurance, and any existing mortgage insurance. The most common error is inputting the original loan amount instead of the current remaining balance. This mistake artificially inflates the projected cost of the new loan. During a cash-out refinance, pulling too much equity can drop your ownership stake below 20%. This triggers mandatory private mortgage insurance. A new PMI fee can completely wipe out the monthly savings gained from a lower interest rate. Ignoring these hidden variables creates a fictional timeline that can trick you into an unprofitable loan agreement. Pushing through a tightly compressed debt timeline is never easy. It requires a heavy, sustained financial effort from the homeowner. When rates drop, many homeowners consider switching from a standard 30-year term to a condensed 15-year term. This quadrant chart maps the trade-off between monthly cash flow and total lifetime interest. The 15-year term provides massive total interest savings, but it forces an inflexible, drastically higher monthly payment. Term reduction is a powerful wealth-building strategy, but it requires sacrificing the monthly cash flow needed for other investments or emergencies. Once you have the raw data from a calculator, you must cross-reference it against your specific stage of life. This decision matrix assigns the 4 major refinancing options to different homeowner profiles. The short timer, moving in under 3 years, should utilize no closing cost options to avoid upfront fees. The cash flow optimizer should use a rate and term refinance to lower immediate monthly burdens, resetting their debt timeline. The wealth builder chooses the 15-year term to eliminate interest and build equity rapidly. The liquidator utilizes cash-out options, maintaining enough equity to avoid PMI and funding appreciating assets. Misaligning your life timeline with the wrong quadrant guarantees a financial loss. A mortgage calculator is an objective trade-off engine that shows exactly what you must give up today to secure a gain tomorrow. You are trading cash today for savings tomorrow, or trading savings tomorrow for cash today. Run multiple scenarios to stress test your break-even point against potential job changes or moving plans. Verify all projected savings independently. Lenders focus on the monthly payment. You must focus on the break-even math. Refinancing is only a victory when you can definitively prove your time in the home will outlast the total cost of the new loan.